Our next guest warns consumer spending activity suggests big trouble ahead. Rebecca Patterson is a former chief investment strategist at hedge fund Bridgewater Associates. She's out with a CNBC op-ed today. The calm before the storm. These three drivers will dictate the landing ahead for the U.S. economy. Rebecca, welcome. Great to see you. Great to have you on Fast again. Before we get to the three drivers, Wile E. Coyote moment. That doesn't sound like a good kind of moment for the U.S. consumer, and that's exactly what you think is going to happen.
I think that's where we're headed. It's interesting. Target was a perfect example of the dynamic. You know, their earnings for right now, fine. Their expectations soft, and the consumer right now, fine. But where are we going? And so when you think about what's holding up the consumer right now, they spent down all their excess savings from the pandemic fiscal transfers. And what struck me and what really prompted me to write this piece was the Federal Reserve report that came out recently that showed that in the fourth quarter, we saw between mortgages and credit cards, $400 billion going on to total household debt balances. That was the biggest increase on a quarter that we've seen in 20 years. And credit card interest rates today are up to 20%, which is also a multi-decade high. And I look at this and say, okay, the consumer keeps piling on credit as long as the job market's tight and they have incomes. But what if companies start to pull back? Or what if consumers just say, maybe I need to be a bit more cautious? And on the latter, we saw that today in the Conference Board February Consumer Confidence Report. It showed current conditions strong, consumer expectations the weakest we've seen since last July. And so we're not there yet. That's what makes this tough. But you're starting to see more and more dots, more and more markers that are telling us that the consumer is going to get more cautious. And when they do, think about the linkages. If the consumer's spending less, it's less revenue for a company. Companies are making less money. Guess what they're going to start doing? Paring back CapEx, paring back hiring. Greater layoffs means there we go and we get the earnings hit. So I do think we're looking at equity market downside later this year. And I would be watching that interplay between the consumer, companies in the labor market, and of course the Fed and those borrowing costs.
Rebecca, it's Tim. Great to see you again on the show. And I guess you're talking about the divergence that is going on between where rates are and where stocks are. And how are you explaining this? Because we're sitting here scratching our heads watching a 65 basis point move on where we've gone in the bond market, pick, you know, the short end or long end. And yet this divergence between where stocks are is very difficult, especially at a time we're finally getting that pullback in EPS, certainly operating EPS following U.S. GAAP and reported EPS. So what do you say to that?
Well, I think there's probably a lot of reasons playing into this, but two that I'm really focused on. One is that the consumer is so strong, and I think there is still a lot of hope out there that we can have a very soft landing, that companies, rather than letting workers go, will simply reduce the job openings and more participation potentially. All those things together could pull wage inflation down, allow the Fed to pause, and the consumer can keep going for some time. I think the other factor that might be leading equities to look through this a little bit is the fact that interest rates are still expected to fall starting at the end of this year. Now, the market has increased its pricing for a terminal Fed funds rate for this year, and now people are talking about 5.5%, even 6% for a terminal Fed funds rate by mid-year. But the market is still pricing that we get rate cuts, significant rate cuts next year. And for the Fed to actually ease, you need to get a lot of economic weakness. You need to get inflation not only to target, but probably below. If those things happen, then I think stocks are going to come down. So I think the market's trying to say, oh, the Fed's going to pivot soon. That'll help us. This is just short term. And maybe we get a soft landing. But I think both of those scenarios, while not impossible, are pretty low probabilities.
So, Rebecca, you're free from the shackles of Bridgewater and you're doing your own thing. So now you can actually talk individual stocks and trading and all that stuff that we used to talk to you about a long time ago. How do you put this to work? Directionally, are you bearish on the markets, or what sorts of trades would you put on to back this thesis?
I mean, right now, we're still benefiting from the China reopening. We're benefiting from incredibly low gas prices relative to what was feared, which is helping Europe's economy and the U.S. consumer. As I said, that's 2/3 of our economy is still kicking strong. So in the immediate future, things look okay. The problem is that as I look 3 months, 6 months ahead, and it's hard to know the timing, I see more and more signs that this thing is going to fizzle out. And so the question is, when do you start taking some chips off the table? I think it depends on your risk appetite. It depends on your time frame, what kind of trader you are. Personally, I'm taking more of a 3 or 6 month view and saying, you know what, I'm going to start building in some of my portfolio insurance now. You know, the T-bill, 6-month T-bill today got to 5.14%. That's the highest it's been since 2007. If I can make 5% plus on 6-month cash, that doesn't seem like a terrible opportunity cost. Are stocks really going to go up 10%, 20% in the next 6 months? I kind of doubt it. So doing a little bit of that, taking some chips off the table, and then within your equity exposure, look, I know the defensives have not had a great year start. You know, utilities are down, what, 6-7% year to date, but starting to take that weakness and use it to build in, again, just a modest incremental slice of portfolio insurance over the next couple of months. So when the party does end, when you have the Wile E. Coyote moment, you're not falling off the cliff. You find a nice cloud to land in.
Rebecca, great to have you on the show. Hope you'll come visit us here on the desk soon. Rebecca Patterson.
Absolutely.